Hey everyone, Emily Carter here. In our last lesson, we talked about what the US stock market really is, how it connects investors and companies across the world. But that brings up the next big question, the one everyone really wants to know. How do people actually make money from it? You've probably seen headlines about millionaires made through Apple stock or long-term investors who retired early thanks to companies like McDonald's or Tesla. So what's their secret? Is it timing? Is it luck? Some hidden insider trick? Not really. It's not magic, and it's definitely not gambling. It's about understanding how wealth in the market is actually created. By owning great businesses, staying patient, and letting time and compounding do the heavy lifting for you. So today, we're going to break it all down, step by step, and show exactly how investors turn small investments into long-term wealth. So, how do people actually make money in the stock market? It really comes down to just two main ways. The first one is called capital gains. That's when the value of your stock goes up over time. You buy it at one price, hold it for a while, and later, when it's worth more, that difference is your profit. The second way is through dividends. That's when the company takes a portion of its profits and shares it directly with investors like you. Let me give you an example. If you had bought Apple years ago for about $5 a share, and today it's trading near $180, that increase in price is your capital gain. But if you owned Coca-Cola, you'd actually get paid every few months just for holding the stock. That's your dividend income. So let's talk a bit more about capital gains. This is basically the increase in a company's value over time. When a business grows, it sells more products, earns more profit, launches better technology, investors start paying attention. That growing demand pushes the stock price higher. But here's the real secret. A lot of beginners miss. You don't actually make money when you buy a stock. You make money when you hold it. Because the stock market rewards patience, not panic. Take Microsoft, for example. Someone who bought shares 10 years ago and just held on, no daily trading, no constant checking, has seen their investment grow by more than 600%. That's the power of time in the market. Now, let's talk about the second way investors make money. Dividends. Dividends are basically your share of the company's profits. When a company earns more money than it needs to reinvest in growth, it often decides to share a portion of those profits with its shareholders. That's you. These payments are called dividends, and they're typically paid out on a regular schedule, most often every 3 months. Think of it like getting a thank you note from the company, but instead of paper, it's cash. Some of the world's most respected and reliable companies have built their reputation on consistently paying dividends. Businesses like Johnson & Johnson, Procter & Gamble, or Coca-Cola. They've been around for decades, they generate steady profits, and they reward their investors for believing in them. And the best part? Dividends are a form of passive income. It's money that shows up in your account while you sleep, literally. You don't have to sell anything or time the market. You just hold your shares and collect your share of the profits as they come in. Let's make it real. If you owned $10,000 worth of Coca-Cola stock in 2024, you would have received roughly $310 in dividends that year without selling a single share. And if you chose to reinvest those dividends instead of spending them, that $310 could buy you even more shares of Coca-Cola, meaning even more dividends next year. That's how dividend investing quietly grows your wealth, one small payment at a time. Now, this is where things get really exciting. It's called compounding. Think of it as your money working to create more money. Here's how it works. When you earn dividends and instead of spending them, you use that cash to buy more shares. Those new shares start earning their own dividends too. And then those earnings keep getting reinvested. It's like a snowball rolling down a hill. It starts small, but as it keeps moving, it grows bigger and faster. To put it into perspective, if you had invested just $1,000 in the S&P 500 back in 1980 and reinvested every single dividend along the way, that investment would be worth over $100,000 today. That's the magic of time and the power of compounding. So let's put everything we've talked about together. Capital gains and dividends. When you combine the growth in a company's stock price with the dividend income it pays you, that total is what we call your total return. It's the real measure of how well your investment is doing, not just the share price you see on your screen every day. A lot of new investors get caught up watching those tiny daily ups and downs. Prices go up a little, down a little, and they panic. But long-term investors focus on total return because that tells the full story. How much value your investment has created for you over time, both from the company's growth and from the cash it's been paying you along the way. So whether it's Apple's rising share price or Coca-Cola's steady dividends, both are part of the same big picture. The real wealth comes from holding strong companies and letting that total return grow year after year. So here's the big takeaway from today's lesson. Real wealth in the stock market doesn't come from chasing quick wins or guessing the next hot stock. It comes from owning great businesses, collecting dividends, and letting compounding work quietly over time. When you think long-term, the market stops feeling like a casino and starts acting like a growth partner, one that rewards patience, discipline, and trust in innovation. And in our next lesson, we'll pull back the curtain on how the market actually runs behind the scenes. We'll explore who regulates the market, like the SEC, the difference between institutional and retail investors, and the hidden roles of brokers, market makers, and ETFs that keep the system moving every single day. So if you're ready to understand the engine of the US stock market, make sure you're subscribed, and I'll see you in Lesson 3.